chapter 7, depreciation. So now let us see what is the meaning of depreciation. Depreciation may be described as a permanent or continuous and gradual shrinkage in the book value of fixed asset. It is based on the cost of asset consumed in a business and not on its market value. So now when coming to the depreciation, in a simple terms we can say that depreciation is nothing but decrease in the value of asset. So here whatever assets we are going to use inside the organization, because of usage of that particular assets, the value of those assets will be decreased. So now that decrease what we have, that itself is called as depreciation. So that is what depreciation is, nothing but decrease in the value of asset. And again, when coming to the decrease in the value of asset, every time we are going to consider the asset value as per the accounts and not as per the market value. It means that what asset we are going to purchase here, that particular asset value will be recorded in the books of account on that particular date. On that particular date, what amount we have recorded, on that we are going to charge the depreciation. On that particular value we are going to charge the depreciation. And at the time of charging depreciation, we are not going to consider the value of the market, but only we are going to consider the value of books of the accounts. So it means that the market value will not be considered, only the book value of the asset will be considered. On that we are going to charge the depreciation to reduce the value of asset because of usage and because of passage of time. Let us see the another definition which was given by Institute of Cost and Management Accounting, London. Okay. So here according to that particular terminology, the depreciation is the diminution in intrinsic value of asset due to use and or lapse of time. So here again it is said that because of the usage and because of passage of time, it was a decrease in the value of asset. So according to Indian Accounting Standard 6 issued by the Institute of Chartered Accountant of India, defines depreciation as a measure of the wearing out, consumption or other losses of value of depreciable asset arising from use, exclusion of time or obsolescence through technology and market changes. Depreciation is allocated so as to charge fair proportion of depreciable amount in each accounting period during the expected useful life of asset. So depreciation includes amortization of asset whose useful life is predetermined. Example of depreciable assets are machines, plants, furniture, buildings, computers, trucks, vans, equipments, etc. So moreover, depreciation is the allocation of depreciable amount, which is the historical cost or other amount substituted for historical cost less estimated salvage value. And other point in the allocation of depreciable amount is the expected useful life of an asset, which means that what asset we are going to use in the organization, it might be any asset, it might be machinery, it might be plant, or it might be the motor vehicles, or it might be the furniture. So any asset will be having its own useful life and it will be having its salvage value. Useful life in the sense, when purchasing the asset, we will be knowing that that particular asset will be used for 10 years or 15 years or 20 years. Again, the asset will be having its own scrap value, or you can call it as salvage value. So when the asset was used for a particular period of time, if you want to scrap that particular asset, what is the value it will be having? By considering all these values, we are going to ascertain the depreciable amount. Again, it has been described, the first one is the period over which a depreciable asset is expected to be used by the enterprise. So as I said, when coming to the particular asset, it will be expected that this many years the asset is going to be used. And the number 2 is the number of production of similar units expected to be obtained from the use of the asset by the enterprise. Okay, so from that particular machinery, what is the production we are going to get? Then features of depreciation, above mentioned discussion on depreciation highlights the following features of depreciation. Now, let us see the features of depreciation, where the first feature is it is decline in the book value of fixed asset. So, as said earlier, depreciation is ascertained on the book value of the asset, not on the market value. So, it is nothing but decline in the book value of asset. What value we have recorded in the books, that value will be reduced. And the second feature here is it includes loss of value due to effusion of time, usage or obsolescence. So, here when coming to the particular asset, when it was purchased and when it is put to the use, the asset will be used and it will be a passage of time. So, here for example, if the asset is purchased in the year 2000, when coming to the 2005, the asset will not remain the same. The value of asset will be reduced. So, that might be the reason here, or it might be usage. The asset what we are going to bring into the organization, every day it will be used. And again, obsolescence. So, when coming to the obsolescence here, it means that what assets were available in the market and when compared to the asset which we have purchased long time back, the features will not match. Due to that, the value of the asset will be decreased. So, let us take one example here. A business firm buys a machine for 1 lakh on April 1, 2000. So, it is April 1st, 2000, and in the year 2002, a new version of machinery arrives in the market. As a result, the machine bought by the business firm becomes outdated. So, outdated is what here? Obsolescence, and the resultant decline in the value of old machine is caused by obsolescence. So, let me repeat once again. What machinery will be available in the market in the future date, the particular machinery's features will not match with the feature of our machinery, so that there will be a decline in the value of asset due to obsolescence. Now, let us see the next feature what we have. It is a continuing process. So, here when coming to the depreciation, the another feature is it is a continuing process. So, now when coming to the depreciation, it is not charged for only 1 year, it is not charged for only 2 years or 3 years. Till the date the machinery was available in the organization, till that date we are going to charge the depreciation every year without missing. So, we are not going to skip any of the year, every year we are going to charge the depreciation. That is what the third feature, it is a continuing process. So, now let us see the next feature what we have. It is an expired cost and hence must be deducted before calculating taxable profit. So, here whatever depreciation we are going to charge, it is a expired cost. It means that the entire year we are going to use the machinery, then we are going to charge the depreciation. The cost was already expired. So, that particular cost have to be deducted before calculating the taxable profit. So, let us take one example here. If the profit before depreciation and tax is 50,000 and the depreciation is 10,000. So, now profit before tax will be, first we are going to take profit before depreciation and tax, which is 50,000 less depreciation 10,000, and the balance 40,000 what we are going to get, that is what profit before tax. It means that before ascertaining the profit before tax, depreciation have to be deducted because it is a expired cost. Now, let us take the next feature where we have it is a non-cash expense. It does not involve any cash outflow and it is the process of writing off the capital expenditure already incurred. Okay, so what this point means here is, when coming to the depreciation, it is a non-cash expense. Non-cash expense in the sense, what depreciation we are going to charge on the asset, that particular depreciation we are not going to pay for anyone. For example, if we are paying salary, salary will be paid to the employees, which is a expenses in cash, okay, which is a cash expenses. But when coming to the non-cash expense here, depreciation is just reduction in the value of asset, where we are not going to pay for anyone, only the value of asset will be decreased. So, here depreciation is a non-cash expense and it is a process of writing off the capital expenditure already incurred. So, capital expenditure in the sense what we are spending on the particular assets or particular furniture, we can take plant and machinery, or we can take furniture, or we can take motor vehicles, on that particular asset which is capital expenditure, we are going to just reduce the value and we are not going to pay for any one. Now, we are done with the features and let us see what are the terms which are similar to the depreciation, or you can say depreciation and other similar terms. So, coming to this concept here, there are some terms like depletion and amortization which are also used in connection with depreciation. This has been due to the similar treatment given to them in accounting on the basis of similarity of their outcome, since they represent the expiry of the usefulness of different assets. So, now let us take terms separately here. One we have depletion and another side we have amortization. So, now when coming to the depletion, the term depletion is used in the context of extraction of natural resources like mines and quarries, etc., that reduces the availability of the quantity of the material or asset. So, here for example, if the business enterprise is into mining business and purchased a coal mine for rupees 10 lakh, then the value of the coal mine declines with the extraction of coal out of the mine. This decline the value of mine is termed as depletion. The main difference between the depletion and the depreciation is that the former is concerned with the exaction of economic resources, but the latter relates to the usage of an asset. So, here the depletion is nothing but where the example was considered of coal mine. So, for example, if a person is purchasing a coal mine and he started extraction of the coal from that particular mine. So, day by day what happens here, when the extraction process is going on, the availability of the coal in that particular mine reduces. So, according to that particular reduction here, the concept will be called as depletion, where the value of that particular coal mine will be reduced. Instead of this, the result in erosion in the volume of natural resources and expiry of the service potential. Therefore, depletion and depreciation are given similar accounting treatment. Now, let us see what is amortization. So, now amortization refers to the writing of the cost of intangible assets like patents, copyrights, trademark, franchises and leasehold mines which have entitlement to use for a specified period of time. The procedure for amortization or periodic write-off of a portion of the cost of intangible asset is the same as that for the depreciation of fixed asset. It means that amortization is applicable on the intangible assets, as I said, like patents, copyrights, trademarks, etc. So, now when coming to that particular patents, it will be considered as an asset where it will be having the right to use in the particular period of time. So, here similar concept is given for these assets also. It will be termed as depreciation of the fixed asset. For example, if a business firm buys a patent for rupees 10 lakh and estimates that its useful life will be 10 years, then the business firm must write off rupees 10 lakh over 10 years. The amount to so written off is technically referred to as amortization. For example, if the patent value is 10 lakh rupees and it is considered for 10 years, so it will be 1 lakh for 1 year and it should be reduced year by year. For example, in 2000 the patent value is 10 lakh, in 2001 the patent value will become 9 lakhs. So, year after year the patent value will be reduced. So, that is what the reduction is called depreciation. Now, let us discuss what is the causes for depreciation. So, now these have been very clearly spelled out as a part of definition of depreciation in Accounting Standard 6 and are being elaborated here. So, first cause we have here is wear and tear due to use or passage of time. So, here wear and tear means deterioration and the consequent diminution in asset value arising from its use in the business operation for earning revenue. It reduces the asset's technical capacities to serve the purpose for which it have been meant. Another aspect of wear and tear is the physical deterioration. So it means that when the particular asset was brought into the organization, the condition will not remain the same. Because of usage, there will be some damages or there might be some scratches on the machinery. Because of that, the particular asset value will be reduced. Even we can consider the passage of time. If the machinery was purchased in the year 2000, when coming to the 2004 or 2005, the asset value will not remain the same, it will be reduced. So this is the first cause of depreciation. And the second cause we have is expiration of legal rights. So certain categories of asset lose their value after the agreement governing their use in the business comes to an end after the expiry of predetermined period. For example, of such assets are patents, copyrights, leases, etc., whose utility to the business is extinguished immediately upon the removal of legal backing to them. Then we have obsolescence. So the third cause is obsolescence. So obsolescence is another factor leading to the depreciation of fixed assets. In ordinary language, obsolescence means the fact of being out of date. Obsolescence implies to an existing asset becoming out of date on account of availability of better type of asset. It means that what asset we have in the organization and what asset was available in the market, it will be upgraded one. So what asset we have, the features of this asset will not match with the asset which was there in the market. It means that what asset we are using in the organization, we will be having better asset in the market. Because of that, this asset what we have in the organization will losing its value. Okay, best example we can take here is a Xerox machine which is used to copy the files or which is used to copy the papers from one print to another print. So now when coming to the Xerox machine, for example, if the Xerox machine when we compared which was available in the year 2000, so where we used to have the manual machine where the person have to change the pages one by one, but when compared to the Xerox machine which is available right now in the year 2017, we have fully automatic machines where no need of any manual instruction. It means that no need to change the papers by the person, automatically it will change the paper and it will be pinned automatically and it will give you the copy. So now when compared to the machinery, when compared to the asset which is available in 2017 and which was purchased in 2000, the value will not be same because of the features. So that is what the cause, obsolescence. And obsolescence arises because of such factors which are technological changes and which are improvements in production method or change in market demand for the product or service output of the asset or legal or other description. So the last cause for depreciation we have is abnormal factor. So abnormal factor means decline in the usefulness of the asset may be caused by abnormal factors such as accidents due to fire, earthquake, floods, etc. Accidental loss is permanent but not continuing or gradual. For example, a car which has been repaired after an accident which will not fetch the same price in the market even if it has not been used. It means that abnormal factors is what which is accidental. So where which is not predetermined. It might be the accident due to fire or it might be earthquake or it might be floods which were not predetermined, which will happen accidentally. So at that time anything which is happened accidentally here, that will be considered as abnormal factor. So now when there is an accident, the asset will be losing its value even if it is repaired, then after repair if it is not used, even though the value will be reduced. So this is also a cost for depreciation. After causes of depreciation, the next concept we have is need for depreciation. So now the need for providing depreciation in accounting records arises for conceptual, legal and practical business consideration. This consideration provide depreciation a practical significance as a business expenses. So now when coming to the need here, first one we have matching of cost and revenue. So when coming to the need, we have to match the cost and revenue of the particular asset so that we can charge the depreciation. So now it means that the particular depreciation needs to be charged to get the matching of cost and revenue. For example, if the particular product is manufactured or if it is produced with the help of machinery, that particular machinery is used in the organization, its cost have to be included in the particular cost, then only we can find the revenue out of the outcome. So now the rationale of the acquisition of fixed asset in business operation is that these are used in the earning of revenue. So here every asset is bound to undergo some wear and tear, and hence loss value once it is put to use in the business. Therefore depreciation is as much the cost as any other expenses incurred in the normal course of business like salary, carriage, postage and stationery, etc. And it is a charge against the revenue of the corresponding period and must be deducted before arriving at net profit according to the generally accepted accounting principles. It means that before ascertaining the revenue, before calculating the net profit, the particular cost which was introduced in the business or which was incurred at the time of production have to be deducted so that to match the principle according to the generally accepted accounting principles. Then the next need we have consideration of tax. So here depreciation is a deductible cost for tax purpose. However, tax rules for the calculation of depreciation amount need not necessarily be similar to the current business practices. So here when coming to the taxation, it is compulsory that depreciation amount what we have, it is deductible, hence it should be deducted before ascertaining the net profit. Then we have true and fair financial position. So here another need for depreciation is to ascertain true and fair financial position. So here if depreciation on asset is not provided for, then the asset will be overvalued and the balance sheet will not depicted the correct financial position of the business. And also this is not permitted either by established accounting practices or by specific provision of laws. Specific provision of law. It means that whatever financial position we have in the business, it will be prepared at the end of the business, which is balance sheet. So now at the end of every year we are going to prepare a balance sheet where we used to have same total both the sides. So one side we will be having liabilities and another side will be having asset. So now when asset value is not reduced year by year because of passage of time or because of its usage, the balance sheet will not give you the fair financial position where the asset value will be overstated even though it is used in the organization. The next need we have is compliance with law. Apart from tax regulations, there are certain specific legislations that indirectly compel some business organizations like corporate enterprises to provide depreciation on fixed asset. Then the next thing we have factors affecting the amount of depreciation. So where the determination of depreciation depends on three parameters, which are cost, estimated useful life and probable salvage value. So before itself I have said that the value of the particular depreciation will be ascertained on the cost of the asset and the estimated useful life and probable salvage value. Even it can be called as scrap value. So coming to factors affecting depreciation, we have three major concepts here. One is cost and the another is estimated life and the another is salvage, or you can call it as scrap value. So now let us take one by one. First we will take cost of asset. So here cost, also known as original cost or historical cost of an asset, includes invoice price and other costs which are necessary to put asset in use or working condition. So here, beside the purchase price, it includes freight and transportation cost, transit insurance, installation cost, registration cost, commission paid on purchase of an asset, and items such as software, etc. So it means that when coming to the cost, it is nothing but the original cost of the asset, which will be included all the expenses until the asset was put to the use. It might be transportation, it might be carriage, or it might be installation, or it might be software related expenses. When combining all the value of the particular things, it will be called as cost of asset. In case of purchase of a second hand asset, it includes initial repair cost to put the asset in workable condition. So now, according to accounting standard 6 of ICAI, cost of a fixed asset is the total cost spent in connection with its acquisition, installation and commissioning, as well as for addition or improvement of the depreciable asset. So for example, a photocopy machine is purchased for rupees 50,000 and rupees 5,000 is spent on its transportation and installation. In this case, the original cost of the machine is 55,000, that is 50,000 is the cost and 5,000 spent for the transportation and installation. Both will be added, the cost of the machine will be 55,000, which will be written off as depreciation over the useful life of the machine. So the next factor we have which is affecting the depreciation is net residual value, also known as scrap value or salvage value for the accounting purpose, is the estimated net realizable value for sale purpose and at the end of the useful life of the asset. So here, what is residual value? It means that for example, if the machinery is purchased in the year 2000, when coming to the 2010, what will be the value of that particular machinery at that particular stage? So that is what the residual value. So now, the net residual value is calculated after deducting the expenses necessary for the disposal of the asset. So it means that the net residual value will be ascertained only after the deducting the necessary of the disposable value of the asset. For example, a machinery is purchased for rupees 50,000 and is expected to have a useful life of 10 years. At the end of 10th year, it is expected to have a sale value of rupees 6,000, but expenses related to its disposal and estimated of rupees 1,000. Then its net residual value shall be 5,000, which is 6,000 minus 1,000 expenses related to disposal, and the residual value will be 5,000. The last concept where we have is depreciable cost. So now, when coming to the depreciable cost of an asset is equal to its cost less net residual value. Hence, in the above example, the depreciable cost of the machine was 45,000, that is 50,000 less 5,000. So it is the depreciable cost which is distributed and charged as depreciation expenses over the estimated useful life of the asset. So here, what value we are going to reduce, that particular value will be called as depreciable cost. In the above example, 45,000 shall be charged as depreciation over a period of 10 years. It is important to mention here that total amount of the depreciation charged over the useful life asset must be equal to the depreciable cost. If total amount of depreciation charge is less than the depreciable cost, then the capital expenditure is under recovered. It violates the principle of proper matching of revenue and expenses. Then we have estimated useful life. So when coming to estimated useful life of an asset is the estimated economic or commercial life of the asset. So physical life is not important for this purpose because an asset may still exist physically but may not be capable of commercially viable production. For example, A machinery is purchased and it is estimated that it can be used in the production process for 5 years. After 5 years, the machinery may still be in good physical condition but cannot be used for production profitability. That is, if it is still used, the cost of production may be very high. Therefore, the useful life of machine is considered as 5 years irrespective of its physical life. Estimation of useful life of an asset is difficult as it depends upon several factors such as usage level of asset, maintenance of the asset, technological changes, market changes, etc. As per Accounting Standard 6, useful life of an asset is normally the period over which it is expected to be used by the enterprise. Normally, useful life is shorter than the physical life. The useful life of an asset is expressed in number of years, but it can also be expressed in other units. Example, number of units of output in case of mines, or number of working hours. Then we have useful life depend upon the following factors. So when coming to the useful life of the asset, it doesn't matter for the physical appearance, but it matters on the capacity. So now we have following factors where it depends where we are going to ascertain the useful life. So the first one we have predetermined by legal or contractual limits. Example, in case of leasehold assets, the useful life is the period of lease. So now if we are purchasing any asset on lease, where we will be not having the entire authority of that particular asset, only we can use that asset for the number of years for which we have taken the lease. So when the completion of that particular lease period, the asset have to be renewed or the asset have to be returned. So now the estimated life will be the number of years we have taken for the lease. And the next one we have the number of shifts for which asset is to be used. So now the particular asset will be there in the organization, and we have to see that how many shifts it has been used in the organization. If the organization is working for 24 hours and the particular machinery will be working for 24 hours, where the estimated life has to be estimated. Then repair and maintenance policy of the business organization. So again, it depends upon the repairs and maintenance policy of the organization. If the machinery is used for 24 hours, so they have to fix the period where the particular machinery will be maintained and it will be having some repairs in the organization. For example, if the maintenance was kept every 6 months, so every 6 months the machinery will be checked here what repairs have to be done and it will be maintained properly. So now when there is no proper maintenance and when there is no repairs, at that time the estimated life of the asset will be very less. Based on this, we are going to ascertain the life of the asset. Then we have technological obsolescence. So as discussed earlier, when coming to the obsolescence, the features or the capacity of the asset will be less when compared to the machineries available in the market. Based on that, we are going to fix the estimated life of the asset. Then we have innovation, improvement in production methods. So now when coming to the particular organization, what machineries we have, on that particular machineries we are going to plan the production method. So if we want to improve the production method, then immediately we will be requiring changes in the machineries. So based on the methods of production, we are going to plan the life of the asset. Then we have legal or other restrictions. So legal or other restrictions here is, when coming to the particular machinery, from the government authorities will be having certain period of life. After that, the particular machinery have to be replaced. So now it is considered by the legal authorities here to safeguard the employees who are working around that particular machinery. So when the machinery is becoming older than older, it will be dangerous for the human resources who will be working in the organization. So now after completion of all this process, let us see methods of calculating depreciation, where the depreciation amount to be charged for an accounting period depends upon the depreciable amount and the method of allocation. For this, two methods are mandated by law and enforced by professional accounting practices in India. These methods are straight line method and written down value method. Beside these two main methods, there are other methods such as annuity method, depreciation fund method, insurance policy method, sum of years digit method and double declining method, etc., which may be used for determining the amount of depreciation. The selection of an appropriate method depends upon the following. So, type of an asset. So, when coming to the type of the asset, the first thing will be having nature of use of such asset and circumstances prevailing in the business. As per Accounting Standard 6, the selected depreciation method should be applied constantly from period to the period. Change in depreciation method may be allowed only under specific circumstances.